All right. Like I said, everything that I've taught you up till now, up to this moment, is actually like the retail method of trading. You've not actually got into the bone of trading itself, whereby, okay, you can be learning to predict most of the move, okay? We are still going to get there. But like I said, I intentionally, apart from the fact that we've been busy with all these calls and preparation and everything, trying to get everything, legal and so official, like I intentionally left you guys to actually practice, but I saw that you were the only one that you have the knack to learn and everything, which I really want to commend you for that. But like there is something that I want to point out is everything you are practicing right now that you've known is the retail method. We are still going to, nullify that later using this method as liquidity. All right. But I'm still going to improve your knowledge today if we have the time. There is something I want to teach you that I want you to, that's the only thing I want you to do is to start back testing. All right. Are you there? So I can hear you. So that's just about it. So those kind of patterns, those retail patterns, they don't really repeat themselves. Yes, I'm well aware of that. But I'm going to show you something that repeats often, like every day. Do you get what I'm trying to say? So, but before that, there is something I want to talk to you about. I saw your comment on, one of my posts on the general channel. Psychology is everything. Did you read you read one of it, right? Like
I read everything.
Like psychology is everything. See, you can have a 50% winning rate. Like this, your strategy can be a 50% winning strategy, and then you are making a lot of money. And then your strategy can be 100% winning rate, can have 100% winning rate, and still lose all your money. So everything comes down to psychology, discipline, managing your emotions and everything. I figured you would have read a little about, psychology and emotions. But the first thing I want to tell you, like I said, okay, when I was teaching the beginners class then, I said I was going to come back to this particular slide to teach risk management because it is actually the foundation of everything. Because this risk management stuff would actually make your foundation very strong because trading is not about technical analysis, it's not about fundamental analysis, it's all about risk and reward. All right, do you get what I'm trying to say? You raised your hand. Do you have a question?
Yes, I have a question.
All right.
I was speaking with Amicable maybe a day before yesterday about this risk management.
Okay.
I said I'm going to ask you by the way, but as I was taking my trade, I was seeing some pullbacks that are hitting my stop loss. So I was hoping you would talk about this risk management also. So I want to learn more about the risk management.
Yeah. That's exactly, before we even start the real technical analysis part, this is the most important thing in trading. All right. I'm literally like, this is the first thing I'm like, now that you've traded, you've seen how it is, you've seen how people win, how people lose and everything, that you've experienced everything. It's time to actually show you something that you really need. Like most traders don't know this at the beginning of their trading career. That's the reason why they lose a lot of money. But you're still practicing with them, hopefully. You get. So I'm going to show you how to firstly calculate risk is in terms of, I want you to, like in the course of this lecture, I want you to start thinking in terms of like risk and reward. Okay. Risk in the sense that this is the amount I want to risk in trading on this particular trade. This is the amount I want to be risking. And then my reward, how much am I gaining if I risk this particular amount? But first, let's go down to the basic part, the calculation part. How do I know the right loss size to use? John, by now, you know about stop loss placement, right? John, are you there?
I can hear you.
SK. Yeah, SK, welcome. I can see you now. All right. By now, you know about, you guys can unmute yourself, provided your background is not noisy. I'm literally in the public right now, but I just want to take this lecture since it's already 6 o'clock. Then after this, I'm going to go to where I'm going. But first, let's talk about calculating your stop loss. And then I'm going to like, there are two things I really want to mention today. I would mention risk management. I will talk about risk management, and then I will talk about trade management. Then after I talk about that, I'm going to teach you one particular strategy that I want you guys to backtest very well. All right. I don't use the strategy because the strategy I use, I have to, start building a foundation for you guys based on liquidity, every. But based on the retail point of view, I want to teach you a strategy that kind of really works. But once you guys backtest that and start making profits, we can start building up on your knowledge. But first, let's start from risk management. Now, you know about stop loss placement already, I would assume, because it's just the beginner's part. Now, look at this place. This particular determining lot size with stop loss. Number one, let's assume you have a $10,000 account. All right. Or let's say a 10,000 USC account, like a cent account. But forget about the currency. Let's talk about the number. That is 10,000. Number one, 1%. Let's say for now, I want you guys to per trade. I want you guys to be risking what? 1%, like I told you guys already. So 1% of 10,000 is what? 100. You get what I'm trying to say? That's just 10,000 divided by 100. That's 100. That means you'd be risking $100 or 100 USC per trade. All right. So if you are risking $100 per every trade, we could have different stop loss. All right. Since we have different stop loss, but we have to use the lot size that would actually, that if price actually hits stop loss, we would actually lose that particular $100. That is actually what this formula is all about. So the lot size that you're going to use is equals to what? Is equals to the risk amount, which is $100 in this case, over the stop loss, over the pips value. The pips value is a constant, which is $10, because you gain virtually $10 per pips if you are using the standard lot size. But the pips value is a constant, $10. So let's calculate something. Now, let's say right now that you want to risk $200. That is the amount you want to lose on that particular trade is $200. That is your what? That is your risk amount. So your risk amount is what? $200. Now, let's say your stop loss is, say, 50 pips. It's set as 50 pips. Remember, your stop loss can be a variance. It can be anything, depending on the particular strategy you are using, depending on the, your stop loss is not a constant. You get, your stop loss can vary. So your stop loss is what? Let's assume it is 50 pips. All right. Now, the pips value is a constant. The pips value is set at 10. Now, calculate the lot size you'll be using. The lot size you'll be using will be the risk amount over stop loss over the pips value. That will be 200 divided by 50. All right. Do you guys understand that? $200 that you want to lose divided by 50, which is the stop loss, is equals to 4. Then divided by what? Divided by 10, which is 0.4. That means you'd be using 0.4 lot size for that trade. If you are using 50 pips stop loss, you'll be using 0.4. That means you'll be gaining $4 per pip. And then $4 per pip times 50 pips stop loss will be 100, is equivalent to 100. Do you get what I'm trying to say? Do you guys understand what I just said?
Yeah.
Let's take another example with our $10,000 capital. I told you, make sure your risk is, your maximum risk for now as a beginner is 1%. Later, when you know what you're doing, you've backtested, your confidence has increased, you can increase your your risk to 2%, 3%, 4%, 5%. But let's constant our risk percent for now to 1%. So 1% of, I'm using, let me share another screen. 1% of, okay, let me just use this one. 1% of 10,000 is what? $100, like we've already established. All right. Since we know is $100, all we want to do is, let's say our stop loss for that trade. All right, let me just go to the charts and show you some purple stuff. Okay. All right, can you guys see the chart? Can you guys see the chart?
Yeah.
Let's talk about this particular trade that I took on. Oh, it's not Euro USD. I actually took GBP USD sales on last week, Friday, before the day ended. But let me just talk about the analysis. Don't worry about whatever you don't understand. It's just the way I analyze and everything. let me just show you guys first. All right, hopefully you guys can see my screen. But the network is kind of bad here. But let's just talk about it. Let's go to the 5 minutes chart. Then I'm going to show you what I was thinking, what made me enter the trade. Now, I trade sessions, like sessions and structure. Now, right here was London session. I'm actually expecting something. Sorry, I made a mistake. Guys, hold on for a couple minutes. All right. Why is there a clear impact? All right. I think I'm just going to have to reset this chart, then I will start again. All right. The indicator is back. Let's go to GBP USD back now. GBP USD. Now, this is GBP USD, and then I'm going to go to the 5 minutes chart. I think it's even right here. Took it. All right, this is just the analysis for next week. Yeah, let's talk about this. Any blue line, let me talk about the this particular indicator. Indicator is not really indicator, it's just trying to tell me something. This yellow line that you're seeing, this yellow box is talking about Asian session. This blue box is talking about the London session. And then this particular red line is talking about the New York session, which I really love. I love London. I love to trade. I trade only 2 sessions, London and then New York session. The only time I trade this particular London close is just when I didn't see any trade for probably there's FOMC, or I didn't see any trade during London or New York. All right. So now, as of that day, I was expecting market structure shift. At first, during Asian session, market was literally here. I was expecting market to break this structure. Then I'm going to look for sales, but market didn't. Then I didn't take any trade around London session. All right. The market went up. Then prior to New York session, I have this break of structure, this particular break of structure right here. All right. Let me mention it. Make it BOS. All right, BOS. Then after this break of structure, normally there is a place I sell from. All right. It's called the imbalance. All right. I'm going to talk about imbalance, all those FVG kind of stuff later in the future. But first, let's talk about the stop loss that I used for this particular trade. All right. All right. Now, this is the imbalance. This is the imbalance means, let me just explain what an imbalance is. Imbalance is normally, this is another imbalance. What imbalance means is that whenever a candle is moving like this, let's say this is a candle, a wick must go beside it and fill it up before going. Like, can you see the move right there? When the candle went down, a wick went to fill the body, and then when the candle went down, a wick went to fill in the body before going down. But here, when the candle went down, a wick went to fill in just the body, but it didn't fill it completely. Can you see? To this side, there is no wick covering it. And then to the side of this body, there is no wick covering it. That is the meaning of an imbalance. Look at it right here too. Like right here, I just want to explain what the imbalance means. I don't want you to know it now. I'm still going to explain it in the future. But that's the basis of this trade. Then right here too, I marked out the next imbalance. All right. Oh, okay. Can you guys still hear me? Hello, are you guys still there?
Yeah, I can hear you.
So like
Yeah,
this.
I can hear you.
Now, this was my point of entry. This is our point of entry. We enter between 2261 and 2264. That is where we'll be placing our sell. But I wouldn't quite enter the sell until price is inside this box. That is inside London, New York session. New York session in Nigerian time is actually 1 p.m. All right, 1 p.m. But in this particular, I'm using New York time. So that's 8 a.m. in New York. Do you get it? That's their morning session. But in Nigeria time, is actually 1 p.m. So at exactly 1 p.m., because I trade time and price, I don't just trade retail. I don't trade retail method. I'm just teaching retail methods so that you guys can get the feel of what retail methods are. Actually, So right here, I'll be entering, and then my stop loss would be right here. All right. My stop loss would be here, somewhere here, at the top of this place. So I'm going to just dim this one. What? SL. SL. All right. It will change it to red. So right here, let's say I enter from this place, as price enter this place by London, New York session. Let's say I entered. What is my stop loss? 7 pips. Let's now assume the stop loss is what? 10 pips. What is the lot size I'll be using? Now, remember, like the demo we are using. Let's say we are using a demo account of say $10,000. All right. 1% of the account is $100, and then I'm using 10 pips stop loss. Using the formula, the risk amount is what? 1%, which is equals to $100, divided by what is my stop loss? $10, which is equals to 10, divided by the pips value, which is a constant of 10. That means I'll be using one lot size for this trade. All right. So one lot size for this particular trade. So the trade is going to look something like this. A minute. The trade is going to look something like this. So that's like a 10 pip stop loss. And then we'll be going down right here. All right. So that's the basics of this, of the strategy that I was just expecting POS and then the imbalance fill. Then I wanted to sell. So can you see what this is? This is called a risk to reward. Can you see the word risk to reward ratio? The risk to reward ratio is something called the risk to reward, like it sounds, the risk to reward. How much am I risking for this trade? I'm risking 100. If the risk to reward is 8.5, that means I'll be gaining, if price actually is TP, I'll be gaining 8 times the risk. That's the meaning of 8RR. That is, 8RR means if you are risking $10, if you gain 8RR, that means you are gaining 8 times 10, which is $80. That means you risk $10 to gain $80. That's the meaning of risk to reward. All right. I'm risking $100 to gain what? $800. Do you understand that? That's the meaning of risk to reward. Everything is risk to reward. That is, if the minimum risk to reward that I recommend is actually 3. That is, if I'm risking 100 here, I should be gaining 300. That means if my target is at, say, 2.5, it's not worth it. That trade is not worth it. But if my target is like, say, 3RR, do you get what I'm trying to say? That means the trade is worth it. And if I see something like 8RR, like something right here, I'm risking $10. That is, I'm risking $100 to gain 800. That's the meaning of risk to reward. I want you guys to actually, go read more about that. But that's the thing. For every trade you want to take, you want to know, you want to, pre-calculate, premeditate the amount you want to be losing. Do you guys understand that? Do you understand that? For every trade, before you take any trade, that's the trap of beginners. What beginners do is that they just, probably price is in their entry. They just want to use any lot size that they feel like, probably 20 lot size, 1 lot size, 0.1 lot size. Risk management is about balance. What do I mean about balance? You don't want to be risking too much, and then you don't want to be risking too low. Imagine right here, when I'm supposed to be risking $100, I am risking $10. I would only have gained $80 when I could have gained what? 800. You get what I'm trying to say? Risk management is about balance. You don't want to be risking low. That is, if you are just probably because you are scared, you use 0.1 here instead of 1 lot size. You would only gain what? You would only gain $80. That's very ridiculous. You get risk management is all about balance. Always think of that. You don't want to be risking too much. That is you don't want to be risking more than 1% of your account, and then you don't want to be risking too low. You get what I'm trying to say? Before I continue, do you guys understand that?
Yes.
All right. So I'm going to move on to trade management. What do I mean by trade management? Trade management is like this. The first thing I want you guys to know is how much are we risking per trade? John, what percent are we risking per trade? SK, what percent are we risking per trade?
10%.
1%. 1% per trade. Now, this was the first trade I took on Friday. Let's assume for any stupid reason, price didn't actually go. Price hit stop loss. That is, I took a loss of 1% of my account. That is, I took a loss of $100. You get what I'm trying to say? You know what I would do immediately? For the second trade that I want to take, let's assume I see another trade. I will not be using 1% again. I will slash my what? I will slash my risk by half. That means I'll be using what? 0.5% for the next trade I want to take. Do you get what I'm trying to say? Like I said, for the first trade that you want to take, as long as it's a win, you are using 1% to this. You get what I'm trying to say? But let's assume you hit SL for any reason. Do you get what I'm trying to say? You don't want to be risking 1% again. You will slash your SL by what? You'll slash your risk by half. That is, you'll be risking 0.5% until you make that loss back. Let's assume you risk for the next trade that I took that day. Let's assume I risk 0.5%. That is $50. You know, the demo account that we're using now, that we are using to actually for this particular lecture is $10,000. 1% is 100. Let's assume this first trade was a loss. Do you get? Let's talk about it here. All right. Hold on for a minute. All right. First trade. Do you get trade one? Trade one. Let's assume is equals to what? Is equals to I lost what? 1% of my account, right? 1%. I've lost minus 1%. Do you get what I'm trying to say? Minus 1%, which is equals to what? Which is equals to, sorry guys, hold on a minute. But can you guys see the text?
Yes, we can. I can.
All right. Hold on, guys. 1 minute. All right. So 1%, which is equals to what? $100. You know, we are trading. Let me just write it here that the balance, our balance, is equals to what? $10,000. $10,000. Do not forget. So 1% is equals to 100. Now we are risking $100, right? We've lost $100. I've lost $100 on the first trade. Now let's talk about trade two. You know, trade two now, like I just taught you, you won't be risking 1%. You'd be risking how much? Trade two.
0.5.
You'll be using 0.5%. And then what's the 0.5% of $10,000? That's 50, right? So 0.5%. And then what's the minimum RR? Are you there? What's the minimum RR? The minimum RR is what? 3, right? Are you guys there?
Yeah.
The minimum RR is 3. Let's say I hit target at that particular time. That means I will be gaining what? 1.5% of my account. You know, 3 times 0.5 is what? 1.5. Which means if I'm risking $50, you know, $50 of this is equals to 0.5% is $50. Don't forget. If I'm using 3RR, if I hit target of 3RR, I'll be gaining 150. That is 3 times 50 is 150. Now, you know, it's 0.5%. That means I've gained, let's say I gain plus 3RR. Okay. Plus what? Plus 3RR. 3RR. Sorry. 3RR. That would be what? Plus $150. Is the same thing as what? Is the same thing as, sorry, it's the same thing as plus what? Plus $150. Do you get? That means I've gained my loss back. And then I'm actually floating $50 profit in my balance. That means the new balance now will be what? What would the new balance be?
10,050.
10,050. That means I can resume risking what? 1%. Are you guys there?
Yeah.
$10,050. So that's just about it. That means I can resume risking 1%. Now, let's say the next trade I take, trade 3. Trade 3. Let's say the next trade I take is TP. How much would I be gaining? Can somebody say that? How much would I be gaining for trade 3?
Okay.
3RR for 3RR. You know we are risking 1% now. That's $100. Okay. 3RR will give us what? $300, right? Are you guys there?
Yes.
John, do you understand? Trade 3, if I hit plus what? Plus 3RR. You know I'm risking 1%. With 1% risk, I'll be gaining nothing less than $300. Do you get?
Yes.
So, which means my new balance will be what? New balance will be 10,350. Do you guys understand? That's how we calculate.
Yes.
Trading is all about calculated risk. It's not about profit. It's not about technical analysis. It's not about the number of trades that you take. That's the mistake new traders make. They just want to take as many trades as possible. It's about calculated risk. See, I can lose if I'm taking 5 trades, I can lose 3 trades, and then the 2 trades I will win, it will give me profit. Let's think about it. Look at this. The first thing, my balance was what? 10,000. I risked 1%. I lost $100. Yes, I don't care. Then the trade 2 that I'll be taking that day, I'll be risking what? 0.5%. Now, 0.5% of 10,000 is $50. If I gain the minimum RR that I trade, which is 3RR, I'll be gaining $150. Don't forget, I'll be gaining $150. You get what I'm trying to say? Now, my new balance, I've already regained the $100 loss that I gained is what? 10,050. Now, trade 3, I'll be risking 1%. Now, 3RR of, if I gain, another 3RR, that will be, I'm risking 1% now, which is $100. I'll be gaining what? $300, which means my new balance would be what? My new balance would be 10,000 or what? 10,350. You get? Then I can keep risking 1%. 1%. Once I encounter loss, do you get? Once I encounter loss again, I will reduce my what? My risk by half and then make the loss back. Then before I resume another 1%. You get what I'm trying to say? Now, there's another thing. Let's assume right here again, I lost again. Let's say right here is minus 0.5%. That means I'm in total drawdown of 1.5%. You get what I'm trying to say? That means I would be slashing my risk by half. That means I'll be slashing my risk to 0.25%. That means I'll be risking $25 per trade until I make all the losses back. Do you guys understand what I'm saying? Do you guys understand that? John, do you understand? SK, do you understand?
Yeah.
Yes.
So
yes.
that's just about risk management and trade management, how to manage your trade. Because you lose one trade does not mean you should go and be crying or you should feel bad. No, it just means you should be careful. Slash your risk by half, because that time emotion can do you. Why? Emotion as in I must make my loss back today. Then you start forcing trade. Emotion as in I've not even seen any trade today. I just want to force trade. You don't want to emotion to actually, because see, trading, let's say you miss an opportunity, trading is once you miss a bus, another one will come around. Let's say you are going somewhere and then the bus you are supposed to take goes, left you behind. What do? Do you start, forcing trade or chasing the bus? No. All you have to do is wait for another bus to show up. That is another new opportunity to show up. You don't have to force any trade. And once you take a loss, that is your first trade, 1%. Once you take the loss, what do? Slash your risk by half. All right. And then what do you do again? Start taking, if you take another loss, structure risk again by half. That means by now you would have gotten to 0.25% risk. Stay there until you recover your loss. Then once you recover your losses, you resume 1%. And then you get what I'm trying to say. You start the journey again. I want you to learn patience when it comes to trading. And then another thing about trade management that I want to give you is this, that whenever you are trading and price has already moved 50% of your profits, that is of your take profits, that is, let's assume you are targeting 3RR and price has already moved what? Price has already moved 1.5RR. You get what I'm trying to say? You reduce your stop loss by what? You reduce your stop loss by half. You get, let's assume, let me show you something. When price got here, that is around 50%, there are 2 things you can actually do to manage your trade. Number one is by taking partials. You get, but I don't recommend that. What I recommend is that, you were using 10 pips SL at first, reduce it by half to 5 pips. That means you trade your stop loss to 5 pips. Do you understand? Then once price has moved 75%, that is, once price is around here, move your SL to what? Move your SL to breaking even. Do you guys understand? That's about trade management. But what another people would do is that once price gets here, that is to 50%, they don't actually move their SL. You get. But once price gets to 50%, they take profit. Then once it gets to the TP, they close the trade and then move. Once it is at 70%, they now move their SL to BE. So I want you to practice with all these things. Do whatever works for you. Okay? Do whatever works for you. And then once you are taking your trade, see, one thing I'm trying to say is that trading is not about probably 100% winning strategy. There is no strategy that does not lose. That is, there is no holy grail. Probably your strategy is not working and then you are searching for a strategy. No, like there is no holy grail. Most of the guru you see online, most of them they don't know how to trade. I'm telling you, they don't know how to trade. They are just showing you fake results, or they are showing you after they've taken like 100 of trade, only one that won is the only thing they post on social media. Then you would now be thinking that, okay, I've not taken any trade this morning. I'm a failure. I didn't take this. No. You don't think like that when it comes to trading. Trading is a personal journey. It's good to have a mentor and all. Yes, it's good to have a good mentor that really understands the nitty-gritty of this thing. But I'm telling you, trading is a personal journey. You don't have to compare yourself with others. Work at your own pace. You will reach the destination is money. Trust me, once you are making $10 every day consistently, you are better than the person that will make $1,000 today and blow $2,000 in the next. You get what I'm trying to say? Consistency is what you are looking for. You are not looking for quick profits. Like I told you in the beginning, trading is not a get-rich scheme. Take your time, learn, backtest, and everything. I'm going to end the meeting now. Then I want you guys to rejoin with the same link because the subscription for this thing, I forgot, is ended. I'm going to subscribe before our next meeting, okay? But this particular recorded meeting would end it here. But do you guys understand what I just explained about risk management and trade management, right? Do you guys understand everything? Do you have any question? John, do you understand? SK, do you understand?
Understand?
All right. Let me end the meeting and then you guys should actually rejoin. Then I'll teach you the strategy I wanted to teach you. All right.